Consider this incredible fact. For over a century after its founding, the nation destined to dominate global finance had no permanent central bank. There was no Federal Reserve, no central authority managing the currency, and no ultimate financial safety net ready to save a collapsing market. Despite lacking these modern essentials, the United States transformed from a shattered, debt-burdened alliance of colonies into the globe's supreme industrial juggernaut. This raises an unavoidable question. How exactly did the nation thrive without the very institutions we now believe are vital for economic survival? The reality of that era is incredibly chaotic, wildly bizarre, and much more eye-opening than standard history books usually care to admit. The country certainly did not just breeze through those early decades, relying purely on a combination of good fortune and relentless pioneer grit. Instead, the young nation stumbled wildly from one financial disaster to another, experiencing extreme periods of sudden wealth, followed by devastating ruin. Early Americans experimented heavily with centralized banking systems, only to viciously dismantle them, watch the alternatives implode, and start the cycle anew. This relentless financial roller coaster ensnared powerful industrial magnates, petty street swindlers, enraged political leaders, and shadowy financiers operating behind closed doors. Countless communities of everyday citizens were also dragged into this monetary turbulence, suffering the real-world consequences of these high-stakes economic battles. Ultimately, this turbulent, messy journey forged the foundation of not only the modern American financial landscape, but the entire global economic structure. Eventually, this endless cycle of panic and prosperity culminated in the highly controversial establishment of the Federal Reserve System in 1913. The actual tale of how that banking institution was finally born is one of the most secretive, bizarre, and impactful events in monetary history. It is a saga filled with backroom deals and dramatic power struggles that fundamentally altered the way money functions in our modern society. Let me guide you through the chaotic origins of this financial behemoth, stepping back into the early days of America's monetary madness. When the 13 colonies broke away from British rule in 1776, they encountered a threat, perhaps deadlier than enemy troops. The wall of change and ways propagated from dinosaurs. That monumental crisis threatening the survival of the new nation was simply figuring out how to handle their currency. Kishinguriting iskandal Egyptin, Camber Cavotingo. The fledgling Continental Congress desperately had to fund an armed rebellion. Yet they lacked any legal authority to collect taxes. The mindfulness of nature is far more equal than the means of concerning it. Furthermore, there wasn't a single ounce of gold in their vaults, nor did any proper banking framework exist. Left with absolutely zero options, the political leaders resorted to a classic move of cornered regimes and just manufactured cash. Over a 4-year span starting in 1775, the government produced roughly $240 million in paper bills. These freshly minted notes were dubbed Continentals, resting entirely on a fragile guarantee of future repayment by the infant republic. During those hopeful early months of the Revolution, everyday citizens willingly embraced these paper slips for their daily trade. However, as the bloody conflict dragged onward and the printing presses ran constantly, the value of those bills rapidly deteriorated. Fast forward to 1780, and the purchasing power of a single paper dollar had plummeted below a single penny, the commentary showing that the largest ashes to stare out. This disastrous depreciation birthed the famous wartime idiom, "not worth a Continental," which citizens used to describe completely useless items. Brave troops who sacrificed everything on the battlefield received their wages in scraps of paper that held almost no value. It became a tragic reality that a veteran's hard-earned salary was completely insufficient to purchase even a simple loaf of bread. Understandably, local agricultural workers grew deeply distrustful of this rapidly collapsing paper tender floating around the colonies. Consequently, those frustrated farmers began flatly refusing to trade their valuable crops and physical provisions for such worthless government promises. Out of sheer necessity, whole towns abandoned the official currency entirely and went back to trading goods directly. This chaotic and bankrupt economic climate was the exact environment into which the infant United States was born. The young nation's initial experiment with government-backed paper had turned out to be an absolute, undeniable catastrophe. Such a spectacular financial failure inflicted deep psychological wounds on the collective mindset of the early American populace. Those bitter economic memories would go on to shape virtually every national debate over banking for the next century. Citizens cultivated a deep-seated, deeply justified paranoia regarding any form of concentrated central monetary authority. After all, they had just helplessly watched their own leaders obliterate their life savings by endlessly running printing presses. This intense public distrust of financial institutions quickly morphed into a formidable driving force in early American politics. However, one visionary argued that rescuing this vulnerable republic required constructing an entirely new financial architecture from the ground up. Exposure is afraid of both signs and excellence. That fiercely determined and forward-thinking individual who took on this monumental challenge was none other than Alexander Hamilton. Unlike a large portion of the Founding Fathers, Hamilton certainly did not hail from the ranks of early American nobility. Instead, he was an orphaned immigrant from the Caribbean islands who began his life with practically nothing. Relying purely on his extraordinary intellect and relentless determination, he clawed his way into the Revolution's elite inner circle. So, when President Washington named him the inaugural Treasury Secretary in 1789, Hamilton walked directly into a massive administrative disaster. The fledgling federal government was drowning in $54 million of war debt, while individual states carried 25 million more. Beyond the crushing debt, America's money itself was virtually worthless, and the financial system was completely broken. Overseas lenders seriously doubted that this untried democratic experiment would even last long enough to settle its accounts. To fix this mess, the Treasury Secretary devised a remarkably bold and highly polarizing strategy. He suggested absorbing every state's financial obligations and merging them into one massive, unified national debt. To oversee this unprecedented financial undertaking, he pushed for the establishment of a powerful central bank. This proposed institution was designed to steady the erratic currency, gather tax revenues, and extend credit to the nation. Furthermore, it was meant to act as a secure central vault for all of the federal government's monetary reserves. The secretary based his grand design on the Bank of England, admiring its immense economic leverage. That specific British institution had famously elevated its home country from a minor European player into an unstoppable global superpower. He viewed this organization as far more than mere economics, explicitly calling it a crucial political engine for the state. By design, it would permanently link the fortunes of wealthy elites and influential merchants to the Republic's survival. If the young country were to collapse, those affluent investors would instantly see their bank assets evaporate into nothing. While undeniably brilliant in its construction, this sweeping centralization of money deeply terrified a massive portion of the populace. The fierce resistance against this plan was spearheaded by two titans of early American politics, James Madison and Thomas Jefferson. As a staunch defender of rural farming communities, Jefferson looked at this proposed financial behemoth with absolute dread. To him, this proposed institution was merely a disguised scheme designed to enrich northern financiers. He feared it would establish a dangerous monopoly, elevating bankers and creditors above the hard-working planters. After all, he considered those everyday agricultural workers to be the true foundation of the American economy. Furthermore, Jefferson fiercely maintained that the Constitution simply did not grant Congress the power to establish such a corporation. He argued that if the federal government possessed the authority to charter a national bank, its reach would become boundless. He gave a particular debate magic. The fundamental principle of a government, restricted by strictly defined constitutional limits, would completely disintegrate. Madison echoed these grave concerns, cautioning that the institution would inevitably funnel vast wealth to a privileged minority. This fierce clash of ideals ultimately fractured the nation's political landscape, creating the first profound partisan divide. On one side stood the Federalists, championing Hamilton's vision of a robust central authority that actively managed the economy. Opposing them were the Democratic Republicans, who fervently advocated for states' rights and a strictly restrained federal apparatus. Jefferson's growing faction harbored a profound, unwavering distrust of any centralized accumulation of financial might. Consequently, this bitter dispute transcended mere economic policy. It became an existential struggle for the Republic's very identity. Ultimately, despite the relentless opposition, it was Hamilton who emerged victorious from this intense ideological showdown. He successfully persuaded President Washington to embrace a much broader, more flexible interpretation of the nation's founding document. By invoking the necessary and proper clause, he proved the government held the unwritten right to build his banking empire. With the legal hurdle cleared, George Washington officially endorsed the legislation on February 25, 1791, bringing the vision to life. Before the year ended, the First Bank of the United States proudly launched its operations right in the heart of Philadelphia. It launched with an unprecedented $10 million in capital, rendering it the most massive corporate entity in the young nation. While the federal government held a 20% stake, the vast majority of shares fell into the hands of private financiers. Parent incensia, inflammatory cars and many elder stoffery. Among these private owners were numerous overseas investors, a detail that left many uneasy American citizens feeling deeply unsettled. Nevertheless, over the next 2 decades, this financial institution performed precisely as its architect had confidently predicted it would. It brought much-needed stability to the volatile currency and expertly handled the complex financial affairs of the federal government. The bridge set about culture despite appearing non-Christian freedom. Furthermore, it actively provided loans to burgeoning businesses, which dramatically smoothed the path for trade across state borders. The institution also served as a strict watchdog over smaller, state-chartered banks by demanding their paper notes be exchanged for hard currency. This clever tactic forced local banks to keep sufficient gold and silver in their vaults, halting the reckless printing of worthless paper money. As a direct result of these measures, the American economy experienced a prolonged period of steady, reliable expansion. Overseas lenders who had once doubted the young republic quickly found their faith restored by this newfound economic discipline. Calms are fast descending the economy and back its senators. Even the crippling national debt, which had once threatened to sink the country, was finally reined in and managed effectively. From a purely practical standpoint, this grand federal banking experiment was an undeniable, resounding triumph. Yet, in Washington, logic rarely dictates policy, and as the bank's 20-year charter approached its 1811 expiration, the political winds were rapidly shifting. The institution's chief architect, Alexander Hamilton, had tragically perished years earlier following his infamous 1804 duel with Aaron Burr. At the same time, Thomas Jefferson's Democratic-Republican faction had secured a firm, unshakable grip over the nation's government. State-level financial institutions had multiplied rapidly, harboring deep hostility toward the federal bank's strict oversight and immense market dominance. This terrified context prevented the division of ground. Furthermore, overseas investors had quietly acquired nearly 70% of the institution's shares, handing critics a devastating political weapon. Fierce opponents passionately argued that British and Dutch financiers were siphoning wealth from American trade, while everyday citizens suffered. In-agent cable testing. When the crucial extension legislation finally reached Congress, it was dramatically struck down in the Senate by a solitary vote. Without fanfare or ceremony, the nation's premier central banking establishment was forced to permanently shutter its operations. Now, the young republic faced the unprecedented challenge of navigating a complex economy totally stripped of federal financial guidance. The consequences of this uncharted territory materialized almost immediately, and the ensuing financial chaos was incredibly ugly to witness. Stripped of a central authority to keep their reckless behavior in check, regional financial organizations multiplied at an alarming rate. To put it in perspective, back in 1811, the nation housed roughly 88 of these localized, state-authorized lenders. Barely half a decade later, by 1816, that figure had aggressively skyrocketed to well over 246. A vast majority of these newly minted enterprises suffered from dangerously low capital reserves and practically non-existent governmental oversight. Taking advantage of the void, they aggressively flooded the market by churning out colossal volumes of their own paper currency. Consequently, the actual worth of this paper wildly fluctuated, heavily dropping in value depending entirely on your distance from the issuing branch. People's confidence in these local branches to actually exchange their printed paper for real gold or silver plummeted. This sparked absolute financial turmoil across the nation, turning everyday commerce into a dizzying, unpredictable guessing game. For instance, a single dollar note originating in Massachusetts could suddenly be valued at 90 cents upon reaching Manhattan. Travel further out to the Midwest, and that exact same piece of currency might only command 60 cents in purchasing power. Shopkeepers and traders found themselves forced to constantly reference complex conversion charts just to complete routine transactions. In more permanent fuel ship, the Clyde ground has a message from point 22. They also had to rely heavily on specialized forgery detection guides to verify if a customer's money was even legitimate. Deception quickly ran wild through the unregulated market, creating an absolute paradise for ambitious scammers and opportunistic counterfeiters. At the darkest points of this crisis, historians estimate that approximately 1 out of every 3 bills changing hands was completely fake. Right in the middle of this economic disaster, the War of 1812 erupted, throwing the country into further chaos. Washington desperately needed to secure massive influxes of capital to properly fund their escalating military conflict against the British forces. However, lacking a centralized federal institution to coordinate these massive wartime finances, the national treasury hit a severe fundraising wall. Desperate authorities were soon reduced to selling off government bonds at massive losses, just to scrape together enough immediate cash. He attempted to support storm-fatal messages as increasing displeasures. They also had to plead with regional lenders for capital, accepting absolutely brutal, sky-high interest rates in the process. By the time the battles finally ceased, the nation's coffers were effectively drained dry, leaving the broader economy in absolute ruins. It became glaringly obvious that regardless of ideological debates, surviving a major war without central banking was impossible, prompting immediate legislative action. Consequently, in 1816, a mere half-decade after the original institution closed, lawmakers officially established the Second Bank of the United States. This revived financial powerhouse was granted a 2-decade mandate to operate, backed by a formidable capitalization of $35 million. Setting up its main headquarters in Philadelphia, the new organization mirrored the operational blueprint of its predecessor almost exactly. National authorities retained a 20% ownership stake, hand-picked a fraction of the board, and securely stored federal revenues in its vaults. Unfortunately, the institution's initial launch was an absolute disaster, plagued by early managers who were profoundly inept and deeply unethical. Those in charge shamelessly handed out massive, unrecoverable loans to their political friends and well-connected corporate associates. These reckless lending practices directly fueled an intense period of real estate speculation, inflating a massive property bubble across the nation. Inevitably, that bubble violently burst, triggering the Panic of 1819, which stands as America's inaugural catastrophic economic depression. Regional lenders imploded everywhere. Desperate farmers faced widespread property seizures, and joblessness skyrocketed to unprecedented levels. Ordinary citizens fiercely pointed the finger at the new national institution for their sudden misery, and their anger was entirely justified. Yet, the tide abruptly turned in 1823, when a highly intelligent and commanding financier named Nicholas Biddle assumed the presidency. Standing in stark contrast to his predecessors, Biddle possessed strict discipline, immense foresight, and a profound grasp of economic theory. Guided by his steady hand, the struggling organization rapidly evolved, ultimately operating much like the sophisticated central banks we recognize today. The new president meticulously controlled the flow of capital throughout the economy, strategically tightening or loosening available credit whenever necessary. He also worked tirelessly to enforce a consistent nationwide currency by carefully regulating the assorted paper bills issued by local lenders. Collarization passed into a rapid wave. Biddle also offered the federal government highly effective financial services, paving the way for an unprecedented achievement. Thanks to his guidance, the nation's public debt was completely wiped out by 1835, a milestone never repeated in American history. Approaching the end of the 1820s, this institution had grown into an absolute titan of global finance. Its printed currency was trusted universally across the nation, holding a value practically identical to solid gold. Commerce boomed from the bustling streets of Boston all the way out to the rugged Western territories. Massive injections of credit helped local enterprises thrive, leaving the entire American economy running remarkably smoothly. Just as prosperity seemed guaranteed, the political landscape shifted dramatically with the arrival of Andrew Jackson. Sweeping into the presidency in 1828, he positioned himself as the ultimate defender of the everyday, working-class citizen. This rugged frontier veteran held a burning, deep-seated resentment for the wealthy financial operators on the East Coast. Years earlier, risky investments had severely damaged his own finances, leaving him permanently scarred by the ordeal. Because of that bitter experience, he harbored a relentless, almost physical disgust for traditional banking and paper currency. He utterly despised any system that allowed a small, privileged elite to hoard the nation's economic power. To the new president, this powerful central institution wasn't a stabilizing force. It was a terrifying, corrupt monster. He He frequently described it as a multi-headed hydra, designed only to line the pockets of rich shareholders and overseas investors. In his eyes, this massive wealth was extracted directly from the sweat of ordinary farmers, laborers, and modest shopkeepers. He viewed Biddle not as a financial leader, but as a reckless aristocrat, holding unchecked dominance over the country's treasury. It frankly did not matter to the commander-in-chief that the financial institution was actually operating quite successfully. For him, it all came down to a single, uncompromising principle that simply could not be ignored. He firmly believed no private corporation should ever dictate the financial livelihood of an independent society. This bitter feud between the president and Biddle quickly escalated into one of the most intense political clashes in American history. By 1832, his congressional rivals, spearheaded by Senators Henry Clay and Daniel Webster, devised a cunning legislative trap. They aggressively pushed a bill through Congress to extend the institution's operating license a full 4 years ahead of schedule. These politicians gambled that he would never risk rejecting such a widely supported measure during a crucial election cycle. Their miscalculation was monumental, as he completely shattered their expectations by immediately striking down the legislation. He accompanied this historic rejection with a fiercely passionate and deeply emotional address that shocked Washington. "The future has done for ours." In his blistering statement, he condemned the establishment as unconstitutional, subversive to state rights, and a threat to public freedom. He went so far as to openly defy the Supreme Court's well-known ruling in the McCulloch v. Maryland case. Even though the highest judges had previously validated the institution's legal standing, he entirely brushed their final decision aside. He boldly proclaimed that the chief executive possessed the absolute right to interpret the Constitution on his own terms. The sheer scale and aggressive language of this unprecedented veto were completely unheard of at the time. Following this fierce declaration, the president transformed the institution's survival into the defining battleground of the 1832 electoral race. He painted the upcoming campaign as an epic struggle, pitting everyday citizens against the corrupting influence of wealthy elites. The writer John Thomas was localizing contact with Back Against the election tour. This populist message resonated deeply, securing him a sweeping victory that he viewed as a direct command from the voters. Empowered by this massive triumph, he escalated his assault by demanding the immediate removal of all government funds from the establishment. These national reserves were then scattered across numerous local state institutions, which his political rivals mockingly labeled as his personal favorites. Furious at this maneuver, the financial director struck back hard by severely cutting off lending across the board. He intentionally engineered a severe financial squeeze, banking on the resulting public suffering to pressure lawmakers into reversing the president's decision. The laws avoided from this hour. This stunningly dangerous power play ended up being a massive miscalculation that completely blew up in his face. Rather than sparking outrage against the chief executive, this economic warfare merely proved everything the president had warned them about. Citizens realized that one unaccountable man had willingly dragged the entire nation into poverty, just to save his own empire. Consequently, when the organization's official mandate finally ran out 4 years later, lawmakers flatly refused to grant it an extension. The nation had successfully dismantled its second major financial hub, closing the doors on a highly controversial chapter. It would take nearly 8 decades before the country would ever attempt to establish another unified monetary authority. The immediate aftermath ushered in an incredibly bizarre and chaotic era for the nation's rapidly shifting banking landscape. This impending era of deep financial turbulence would severely test if a growing, complex society could even survive without a central anchor. Spanning from 1837 to the early 1860s, this peculiar time frame earned the fitting title of the free banking era. That very moniker perfectly encapsulated the completely unrestrained philosophy driving the nation's decentralized financial system at the time. Across numerous territories, starting a monetary institution suddenly became surprisingly accessible to almost any ordinary citizen. As long as an individual could scrape together a little starting capital and fill out basic paperwork, they were in business. The national government completely stepped away from oversight, leaving an absolute void when it came to federal financial regulation. The point started without access. They wondered what it would be. Consequently, individual states were left entirely to their own devices to establish their own unique industry guidelines. In several regions, local authorities implemented legislative frameworks so incredibly loose that genuine rules practically did not exist. Most importantly, every single one of these newly formed businesses possessed the authority to print independent paper money. These custom banknotes were supposed to be firmly supported by whatever tangible assets the founders held in their vaults. Typically, this underlying value came in the form of local government debt, property mortgages, or physical precious metals. What materialized next was a massive surge of economic innovation, closely intertwined with absolute monetary mayhem. Unsurprisingly, this completely unregulated environment also gave birth to frequent, jaw-dropping instances of spectacular financial fraud. On any given day, thousands of entirely distinct paper bills were simultaneously floating around the broader national economy. Every piece of circulating cash featured completely unique artwork, varying face values, and wildly different degrees of actual reliability. A merchant traveling across state lines would constantly juggle dozens of currencies, navigating fluctuating values tied to a distant bank's reputation. To navigate this monetary maze, shopkeepers and traders depended heavily on specialized publications, known as banknote reporters, to determine accurate currency values. Yet, despite having these reference manuals at their disposal, the entire financial framework remained a terrifying landscape of perpetual uncertainty and tremendous hazard. This completely hands-off approach to economics ultimately spawned the era's most notorious institutions, the legendary wildcat banks. Legend suggests they earned this colorful name by establishing their headquarters in rugged, isolated wilderness areas inhabited only by fierce predatory felines. Their isolation was entirely intentional, designed to make it nearly impossible for customers to actually show up and trade their paper money for physical hard currency. The most outrageous illustration of this deceptive practice unfolded during the chaotic years of 1837 and 1838 across the state of Michigan. Lawmakers there had just enacted one of the nation's pioneering free banking statutes, fundamentally changing how financial institutions could be formed. In the wake of this legislation, a sudden tidal wave of brand new banking ventures sprang into existence in a matter of months. While a small handful of these fresh institutions operated honestly, a vast majority were little more than sophisticated scams waiting to happen. Government regulators were officially tasked with visiting these establishments to physically audit their vaults and confirm their required precious metal deposits. Unfortunately, these state inspectors were severely lacking in resources and hopelessly outnumbered by the sheer volume of newly minted operations. Rumors soon spread about corrupt bankers literally smuggling the exact same heavy lockbox of coins between different branches. By coordinating their movements perfectly, these fraudsters managed to stay just one step ahead of the traveling government auditors at all times. The whispering movement is greatly alarmed. This clever shell game successfully fabricated a mirage of immense wealth, hiding the dark truth that their collective vaults were actually completely bare. In the most extreme cases, these so-called businesses were nothing but phantom entities, boasting zero staff, zero actual buildings, and absolutely nothing backing their name. These scam operations never had the slightest intention of actually honoring the colorful paper money they so aggressively printed. Their entire strategy was to saturate local markets with their fabricated cash, let the bills spread, and then suddenly disappear without a trace. The unfortunate citizens left holding those bills quickly realized their supposed wealth had turned into entirely useless scraps of garbage. Yet, despite these horrifying stories, modern historians emphasize that this era of unrestricted finance wasn't quite the absolute disaster we often imagine. Recent studies reveal that the most blatant scams were actually confined to a few specific regions, like Michigan, which suffered from exceptionally poor oversight. Conversely, in areas with stronger legal frameworks, such as New York, many of these independent financial institutions actually managed to run rather smoothly. That isn't to say it was perfectly safe, as an alarming 50 to 60% of all independent vaults eventually went out of business. Surprisingly, though, many of those shutdowns were managed professionally, allowing the public to successfully recover the vast majority of their hard-earned savings. The factor still started to name it follow as a doctor at both sides. So, while the national financial landscape was undeniably disorganized and chaotic, it wasn't a total, unrelenting catastrophe from coast to coast. Even with that nuance, the country was still deeply traumatized by severe, recurring economic shocks that routinely shattered people's lives. Massive, sweeping crashes battered the American economy relentlessly, striking in waves during 1819, 1837, and continuing straight through the 19th century until 1907. If you look closely at these historical disasters, you'll notice that almost every single one of them unfolded following an incredibly predictable, toxic pattern. Things always began with a massive, euphoric boom, driven entirely by wild speculation and loans being handed out to just about anyone. But then, public trust would instantly evaporate, triggering a terrified stampede of citizens desperately trying to withdraw their deposits and cash in their notes. This frantic rush always sparked a deadly domino effect, causing countless branches to collapse entirely and freezing the nation's credit almost overnight. The resulting financial depressions left countless Americans jobless, wiping out vast empires of wealth alongside modest family savings. Since the country lacked a central bank to serve as a final safety net, there was no official way to pump emergency cash into dying markets. Once the public's faith vanished, the government simply didn't possess any built-in safeguards to halt the cascading financial ruin. Instead, the nation's survival hinged on frantic cooperation between independent financial institutions and local clearinghouse groups. Whenever things got truly dire, the economy had to be bailed out by the sheer financial muscle of a few ultra-wealthy tycoons. During these absolute lowest points, the entire financial framework survived purely on desperate hope and makeshift solutions. Everything abruptly shifted once again when the outbreak of the Civil War forced a massive overhaul of the country's monetary structure. Pramkal Banti, for an underground. By 1861, the Northern leadership found themselves staring down the exact same crisis their predecessors endured during the Revolutionary War. They were burdened with the monumental task of funding an extraordinarily expensive military conflict, without any clear method to generate the cash. This impossible situation fell to Treasury Secretary Salmon Chase, who quickly engineered a bold strategy to save the Union's finances. His emergency blueprint was so incredibly impactful that it ended up dictating the trajectory of U.S. South banking for the following half-century. The first major step involved pushing Congress to legally approve the creation of approximately $450 million in fresh bills. Citizens quickly nicknamed these new government notes greenbacks, a simple nod to the distinct emerald dye stamped across their reverse side. For the very first time in its history, the United States finally possessed a unified, federally backed paper monetary standard. These historic notes functioned as universally accepted legal tender, mandated by law, to settle practically any public or private financial obligation. Crucially, these new bills weren't tied to any physical reserves of precious metals like gold or silver. Instead, their sole foundation rested on the promises of a federal government embroiled in a highly uncertain civil conflict. Because the Union's ultimate victory was far from assured, public confidence wavered, inevitably triggering a familiar economic consequence. Prices began to climb as inflation took hold, mirroring the financial struggles of the Revolutionary period, albeit somewhat less severely. During their most depreciated phase, the perceived value of these wartime notes plummeted drastically in the open market. In fact, weary citizens could exchange a single paper dollar for only about 35 cents worth of actual gold. However, the truly permanent transformation of the American financial landscape arrived shortly after, with sweeping new legislation. Lawmakers pushed through the monumental National Banking Acts during the height of the conflict in 1863 and 1864. The company was discovered by the 1970s. This pivotal legislation established a robust network of federally authorized financial institutions across the divided nation. Book shows the divided nation. These officially approved branches were finally granted the power to distribute a freshly standardized national currency to the public. Yet, there was a major catch. They had to buy federal government bonds up front to guarantee their newly printed cash. For desperate Treasury officials scrambling to fund expensive military campaigns, this legislative strategy was an absolute stroke of genius. It instantly generated a massive, captive buyer base for wartime debt, securing essential government loans at highly manageable interest rates. Furthermore, it streamlined everyday transactions, as all authorized bills shared identical designs and were legally secured by federal collateral. To guarantee the total elimination of lingering regional money, politicians slapped a crushing 10% penalty on any state-issued notes. While this federally regulated framework was a huge step up from the wildcat banking days, a true central institution was still conspicuously missing. The nation lacked a supreme financial overseer, capable of adjusting the money pool or bailing out struggling lenders during intense panics. DSL. Consequently, the newly established financial architecture remained dangerously stiff and entirely incapable of adapting to sudden economic shifts. Because paper money was strictly anchored to federal debt, the amount of circulating cash couldn't stretch or shrink to match actual commercial needs. This flaw became glaringly obvious every fall when agricultural workers desperately required loans to transport their massive harvests to buyers. During these crucial harvest months, the intense scramble for available funds caused borrowing costs to skyrocket to agonizingly high levels. Then, as winter thawed into spring and agricultural trading slowed down, the unused capital rapidly migrated back toward the East Coast, flooding into the massive vaults of New York institutions. This surplus cash predictably ignited wild speculative frenzies across the stock market. This endless, predictable cycle of cash, rushing in and out of the heartland, produced a deeply unstable economic environment, year after year. The severe brunt of this relentless volatility fell squarely on the shoulders of hard-working agricultural communities scattered across the South and West. It was a large principle of untergereist and tilt. They reasonably concluded that the whole economic apparatus was rigged to enrich wealthy northern industrialists while leaving rural workers to suffer. The reporting data was born because of these fatal structural flaws. Devastating financial crashes relentlessly battered the country throughout the late 19th century, carrying quickly in the fire with confidential success. The painful economic crises of the 180 cities, 90s, all hammered home one terrifying, unavoidable reality for the American public. Without a powerful centralized bank to stabilize the turbulent markets, the nation's fragile economy was sitting perfectly exposed to sudden collapse. The moment public trust vanished, there was absolutely nothing to cushion the fall, forcing desperate local banks to freeze cash withdrawals entirely. Countless commercial enterprises would collapse entirely, causing joblessness to skyrocket and leaving entire towns utterly ruined. Eventually, the economic tempest would blow over, allowing optimism to slowly creep back in and restart the vicious loop. It was an endless rhythm of incredible growth, paired with terrifying weakness, a combination that simply couldn't endure permanently. The definitive breaking point that finally shattered this unstable status quo struck during the autumn of 1907. Surprisingly, this specific disaster wasn't actually the deepest economic plunge the United States had ever endured. Previous economic slumps in the late 19th century were easily more destructive and stretched on for much longer periods. However, this new catastrophe possessed a uniquely intense human dimension that completely distinguished it from past events. It vividly exposed the sheer madness and extreme peril of the American financial structure, making the flaws glaringly obvious. The sudden chaos originated from a disastrously botched scheme to monopolize the shares of the United Copper Company. An ambitious market manipulator named Augustus Heinze partnered up with Charles Morse to pull off this massive gamble. The duo heavily leaned on a complex web of banks and trust organizations to bankroll their reckless operation. Once their grand attempt to corner the market completely imploded, the resulting fallout was swift and terrifying. Everyday people who held accounts at the institutions tied to Heinze and Morse were gripped by absolute panic. Desperate to protect their livelihoods, these terrified account holders rushed in droves to pull their savings out entirely, and the same has the stimulation of lower trading care display. This localized fear instantly caught fire, spreading the massive bank run from those first few branches into the wider network of trusts. These trust organizations were the system's weakest link, fiercely fighting national banks for customer deposits, while enjoying far fewer regulations. They also kept dangerously low cash reserves on hand to cover any sudden surges in client withdrawals. Furthermore, they were completely excluded from the New York Clearing House, a private union that organized mutual aid for major banks. Disaster truly struck when this central group outright refused to provide an emergency lifeline to the Knickerbocker Trust Company, Catalona. Because Knickerbocker was the city's third largest trust, this sudden denial of assistance immediately triggered an absolute frenzy. It's best to understand it. Terrified customers swarmed the streets, forming massive, winding queues outside the institution's heavy doors. Everyone was locked in a desperate, panicked race to pull out their cash before the vaults ran completely dry. The ultimate breaking point arrived on October 22, 1907, when the Knickerbocker abruptly halted all of its daily operations. The rooted VR gathering doors had no notice about the operations. Without any warning, thousands of everyday citizens suddenly found themselves completely blocked from accessing their own life savings. This devastating closure quickly mutated into a much larger threat, one that could easily devour the entire national financial structure. Shockingly, the federal government possessed absolutely no central authority or emergency funds required to halt such a massive, cascading collapse. Therefore, the monumental burden of rescuing the nation's fragile economy landed squarely on the shoulders of one specific individual, Deep Center, Pacific form of radian bird. This unexpected savior was a 70-year-old titan of finance, famously recognized for his intensely intimidating stare, John Pierpont Morgan. Despite being the world's most influential private banker, Morgan was actually attending a peaceful church gathering in Virginia when the chaos erupted. Morgan now was sentenced to the first day to event. He immediately abandoned the religious convention, rushing straight back to his Madison Avenue private library to take command of the unfolding disaster. You know what happens when you're writing a bounce. For the following 3 weeks, the venerable financier effectively operated as the nation's singular, independent central bank. He demanded that the heads of the city's leading financial institutions gather immediately within the walls of his study. There, he meticulously scrutinized their ledgers, playing judge and jury to determine which firms were financially sound and which were doomed. For the institutions deemed salvageable, he rapidly structured massive rescue funds to ensure their doors remained open. Leading by example, the Titan committed vast portions of his personal fortune to stabilize the teetering market. Through sheer force of will, he then pressured his immensely wealthy peers to open their own vaults and follow suit. His influence even reached Washington, as he convinced the Treasury Secretary to inject $25 million of federal cash directly into Manhattan's banks. To avert an absolute collapse of the stock exchange, he carefully engineered the emergency acquisition of a crumbling brokerage house. He enjoyed a priceful temperament to fasten the eternal town back against the conflict. This aggressive maneuver controversially required the explicit blessing of President Theodore Roosevelt. This was an ironic twist, considering the commander-in-chief had built his political reputation aggressively dismantling the monopolies of tycoons like him. The crisis peaked during one incredibly tense evening when the tycoon essentially imprisoned the city's top trust executives inside his library. When the city enters our part of the city, he firmly locked the heavy doors, refusing to release anyone until they collectively committed $25 million to bail out their weakest competitors. He picked around his wrath bar step. The standoff lasted deep into the night, with the final exhausted executive finally surrendering his signature at 4:45 in the morning. This heavy-handed, brilliant strategy actually worked, successfully breaking the fever of the panic and saving the system from ruin. Yet, while the immediate disaster was narrowly averted, the terrifying ordeal laid bare a deeply unsettling reality about the world's mightiest economy. Before the dust settled, one final maneuver required the blessing of President Theodore Roosevelt, ironically a leader famous for battling corporate titans like Morgan. The sheer survival of the nation's markets didn't depend on strong legislation, government agencies, or formal regulations. Instead, it relied entirely on a solitary, aging tycoon willing to deploy his personal wealth and forcefully bend colleagues to his will. A chilling question began to ripple through the public consciousness. What exactly would the country do once this financial patriarch was gone? Citizens wondered how the nation would survive the next inevitable crash without a staggeringly wealthy individual stepping up to staunch the financial hemorrhage. The terrifying conclusion was undeniable, pointing everyone toward the absolute necessity for fundamental structural reform. Unlike the aftermath of earlier economic disasters, the severity of the 1907 crash finally forced a reluctant Congress into taking decisive action. By the following year, a formidable Rhode Island legislator named Nelson Aldrich stepped forward to spearhead a brand new legislative initiative. As a leading conservative figure, the senator also maintained deeply entrenched relationships with the most powerful elites running Wall Street. Today's podcast is fit for the whipsters to move safe. He successfully pushed a bill that established a special commission tasked specifically with diagnosing the country's banking flaws and devising permanent remedies. Yet, the man leading this critical charge was incredibly polarizing, drawing both immense respect and intense public scrutiny. Even the president himself acknowledged Aldrich's vast political influence, describing him as the absolute mastermind of his party. Meanwhile, cynical reporters gave him a far less flattering title, frequently referring to him as the unofficial dictator of America. Public skepticism only deepened when citizens remembered that his own daughter was wed to the heir of the massive Rockefeller empire. Despite the swirling suspicions, the senator spent the subsequent 2 years traversing Europe, carefully analyzing how foreign powers managed their central banks. Although he crossed the Atlantic strictly against the concept, the efficiency of the German framework completely won him over. But that's quite a calculated adult confinement. He sailed back across the ocean with a firm conviction that the United States absolutely required an identical structure. Yet, a massive obstacle stood in his way, as the general public maintained a fierce hatred for centralized banking. History proved this hostility, as 2 prior efforts to establish such an institution had resulted in absolute political disaster. The everyday citizen harbored a deep-seated terror of monopolized financial authority, a powerful sentiment stretching back for generations. It was the exact same populist anxiety that had fiercely driven legendary leaders like Thomas Jefferson and Andrew Jackson. Because of this ingrained paranoia, any legislation visibly crafted by wealthy Wall Street elites would be immediately rejected. Recognizing this impossible political climate, the determined politician decided to pull off an unbelievably bold and unconventional maneuver. Part 3 hinders direction. During the final months of 1910, he discreetly coordinated an unprecedented and highly classified gathering of financial titans. The true nature of this clandestine summit would successfully remain completely concealed from the masses for over 20 years. Under the cover of darkness on November 22nd, a handful of elite figures quietly boarded a private railway car. This stealthy late-night departure took place at a relatively unassuming train terminal located in Hoboken, New Jersey. Karen disappeared. To maintain absolute anonymity, the prominent guests were ordered to travel independently and speak only using their first names. The group's utmost priority was making absolutely sure that nobody saw these incredibly powerful men associating in public. To sell their fabricated alibi of a casual hunting excursion, one participant even lugged around a borrowed shotgun. Their fabricated excuse for the journey was a simple duck hunting excursion down to Jekyll Island, just off the Georgian coastline. But there were no birds to hunt. Their actual destination was the nation's most elite, heavily guarded private retreat. This secluded sanctuary was the personal playground of Gilded Age billionaires, including legendary tycoons like J.P. Morgan and William Vanderbilt. Hidden away from the public eye, these men gathered with a single, monumental goal: to completely rewrite the rules of American finance. The covert roster featured Senator Aldrich acting as the mastermind, accompanied closely by his trusted personal aide, Arthur Shelton. Representing the massive influence of Wall Street was Henry Davison, a top-tier executive deeply embedded within the J.P. Morgan empire. They were joined by A. Pyatt Andrew, a prominent government insider who held the crucial role of Assistant Treasury Secretary. Also present was Frank Vanderlip, who commanded the colossal National City Bank and acted as a proxy for the vast Rockefeller wealth. Rounding out the secretive cabal was Paul Warburg, an immigrant banking prodigy representing the financial powerhouse of Kuhn, Loeb and Company. Despite the immense wealth and authority gathered in that room, it was the German-born Warburg who truly directed the conversation. He possessed an unmatched, encyclopedic knowledge of how central banks operated across Europe, having spent his life studying their intricate mechanics. He had to go faster. For years, he had been the loudest voice warning the nation, tirelessly advocating for radical changes to America's fragile monetary structure. Over the course of their secret retreat, these financial titans successfully hammered out the blueprint for what would eventually become the Federal Reserve. That highly classified gathering ultimately birthed our modern banking system, quietly securing their grip on the nation's wealth behind closed doors. If you want to uncover more hidden truths about the history of money and power, drop a like, subscribe to the channel, and leave a comment below. Here, in this program, we can venture out of 2 stars in front of your crew.